Tenaz is currently, most people will know, my largest stock position, as I see a great runway in front of it for greater appreciation. And so if you don't know, the Tenaz trades in Canada as TNZ, sorry, in Toronto, ATUUF in US OTC, and 7F4 in Germany in the Frankfurt market. Before we start with the presentation, Tony, just out of curiosity, I would like to know, how did you come about choosing a Spanish word for your company? You know, in my Discord, we have a lot of Spanish followers, albeit we have a lot of people from all around the world as well. Can you give us some color on this?
Okay, yeah, that's an interesting question. Well, we quite like the name. We like the word. We think it has a lot of kind of panache to it. We always say Tenaz, but probably the correct Spanish pronunciation is Tenaz, I believe.
Yes,
you can correct me. The word means tenacity. We view what we do as very tenaciously, very in a very disciplined fashion, a very consistent fashion, seeking out value for the owners of the company, owners like you, owners like the management team, since we were all participants in the original recapitalization, owners like the rest of our employee base who are all incentivized with equity, seeking value for the owners of the company, and just trying to do that as tenaciously as possible. We like the Spanish language. I'm from the United States, and most people there grow up with some working knowledge of Spanish. I can't say that I'm fluent. I wish I was, because to me it's a great language, a very beautiful one. So we thought about really the philosophy of the company that we wanted to convey. We wanted a name in a language other than English. We like Spanish, and again, to me, Tenaz or Tenaz has a really strong ring to it that we thought people would be able to relate to and kind of remember the company by. We also, you can see it on the cover slide of our presentation, we also picked the shark as a symbol, our logo of the shark swimming in the water. It wasn't so much particularly about offshore. We are really open to either onshore or offshore, but the idea was that the shark is a symbol of tenacity, so it went with the name Tenaz or Tenaz, as we mispronounce it. But we're quite proud to have a Spanish name, and from the very beginning, before we really had assets or assets beyond the Altura recap, Leduc Woodbend, we felt we had a really good name and a really good logo to start with. So that's how we arrived at it.
Yeah. Okay. Thank you for that. Yes, I agree. It sounds very good. Okay, Tony. So without any further to do, I think the best is if you can proceed with the presentation. And
okay, let's go with slide one.
Yeah. Afterwards, we can have a question and session. Question and answer.
So here we see the name, and I think this really good logo that we have for the company. Also, three pictures displayed here showing the range of our assets currently in the company. Of course, we want to expand this over time. On the left, we have a picture from when we were drilling, and then just ongoing pumping operations in Leduc Woodbend, our very strong oil field that we have there that we inherited from Altura, and I'll talk more about that later. That is in central Alberta, just south of Edmonton. In the middle, we have the onshore portion of our midstream asset in Netherlands. This is the plant that handles the offshore production right on the northern Dutch coast. And on the right, we have the upstream portion of the Netherlands assets, or one of the platforms operated by Neptune in the shallow water, close into shore, Dutch offshore. If you could go to the second slide, please. We went through it pretty briefly. I don't expect you to read it right here. It is available on our website, as is the whole presentation at tenazenergy.com. But this is our advisory on forward-looking statements. I'll point out also that I've got about a 25-slide deck here. I'm going to cover some of the slides very, very briefly. Some I'm going to skip over just in the interest of time. And again, I'd encourage you to go back to the website to take a closer look at it. I'll start with a corporate overview. Really picks up on slide 4 with a description of what we're seeking to do in Tenaz. Again, international company, TNZ on the TSX. At present in the company, we have this semi-conventional oil development project in Canada, and the European natural gas assets, both upstream and midstream. In aggregate, they provide growth at the same time that they provide free cash flow to the company. We are debt-free. In fact, we have pro forma negative net debt after the most recent deal of about 65 million Canadian. And we feel we do have access to the capital markets, demonstrated at the time of the recap. And from everything we can tell, that would certainly be the case today, probably even more so since the time of the recap about 21 months ago. And finally, we do think this management has a record of creating value in this model using M&A. In this case, we're going to stress it in the overseas markets, and then subsequently being able to provide operational improvement on top of the good valuations that we find overseas. So a model we've run before successfully. Our objectives going forward, we intend to continue to very carefully evaluate assets, to make decisions about whether or not to make offers on them in a very disciplined, consistent fashion. When we make a deal, we would expect it to be a one that is relatively low risk and relatively high return because of the nature of the market that we're operating in, and also the very careful approach that we take. We're going to be dealing primarily with producing assets, sometimes exploration upside, but really that's not our objective. Primarily our objective is to acquire producing assets with existing free cash that can be improved going forward. Geographically, our focus is primarily in Europe, secondarily in Middle East, North Africa, or MENA, and a tertiary option that we have in the Americas as well, primarily Latin America, but to some extent optionality for Canada, in addition to the non-domestic markets. As I mentioned before, we're going to be using our technical and operating capabilities to improve performance after acquisition. This would be, of course, particularly true when we're an operator, but would apply to some extent even in the non-operating mode. And the objective of all of this is to build a portfolio of assets that are conducive to a growth and income model in the public markets. Historically, we had used dividends at the previous companies in that growth and income model to provide the income component of it. And longer term, we do see that as an objective we would have at Tenaz. At present, at our small size today, we are providing this cash return really through a modest buyback program that we have in the stock. So that is what we seek to do in Tenaz. If we could move on to slide 5, I'd like to briefly cover the management team of the company. I am the CEO, previously ran Vermilion, Baytex, and the Canadian subsidiary of Dominion Energy, the big U.S. utility that at one time had a big E&P company. Prior to that, I worked for U.S. Independence, Canadian Independence, and started my career with a major Atlantic Richfield, or ARCO. And I am a petroleum engineer, is my primary background. Mike Kaluza is our Chief Operating Officer. I've worked with Mike for probably more than a couple of decades at Baytex, Dominion, and most recently at Vermilion, where he was COO, running 100,000 BOED operation with assets in a wide range of countries. He too is a petroleum engineer, educated in the U.S. Brad Bennett is our CFO. We worked with Brad at Vermilion Energy, where he was treasurer, and before that, manager of financial reporting. He is a CPA starting at Deloitte. And then the remainder, our other three officers, Jen Russell Houston is our VP of Geoscience, comes to us after a great success as the development leader at OSIM, a very successful oil sands company that ultimately sold a couple of years ago. John Balkwill is an engineer who is our VP of Business Development. We worked with John at Vermilion, where he was in the BD program and also asset management. He had a variety of international assignments earlier in his career. And David Burkhart is other officer in the company. He had been the CEO of Altura, and we worked with him as well at Vermilion, where he had a very successful tenure running our as the managing director of our French assets, and he worked on a variety of the European positions that we had at Vermilion. It's a strong team, and there's a number of very strong technical people and finance people behind them as well. And again, all of these officers, original investors, as were the directors in the recap, and everyone in our company is incentivized with an equity position. We want everybody pulling in the same direction, and that is to add value for the shareholders.
So, Tony, just one thing. I remember now an older presentation where there was this slide where it talked about the performance that you got per share with both Vermilion and Vitex. And also, I think it was talking about the growth in dividends as per your model to return capital to shareholders. Could you comment a bit on that performance, past performance?
Oh, for sure. I think what we were doing there in some of the original marketing of the recap, and I think I used that presentation in a Romanian forum as well at Energynomics. We were detailing the relative performance of Vitex and then Vermilion during the period of the management tenure there, using the days of my tenure in the C-suite. It was a good record, and we're proud of it. At Vitex, I believe this is 04 to 12, there were, I think, 47 intermediate Canadian companies in the public market at that time, much larger industry, I guess, in terms of the number of companies than it is today. We were first, I think, if I'm correct on that number of 47, we were first out of the all the intermediates. And we had quite a bit of outperformance relative to the index. I think we were 220% above for that 8-year period, something like that. So we always kind of have to measure on relative performance to sort of wash out the volatility maybe in the commodity price. But we're proud of that record. It's hard to be number one, and we did hit it during that period. I think the exhibit you're talking about also for each of the companies details the dividend and production dividends we had, and then the production growth, and very much ran a growth and income model there with a lot of growth in production while we were had a very significant payout at Vitex. We have had on that slide the same two panel for Vermilion, a little bit different industry time, 2012 to 20. Became sort of a tough decade with some of the drops in price that were pretty durable during that decade, and kind of a change in acceptance of the industry, I would say, in the public markets then. Hopefully we can have a revival of kind of oil and gas desirability and acceptance as we look forward to the rest of this decade. The relative performance in that time, I think we were down to, if I remember correctly, 24 companies in the intermediate sector in Canada in the public market. We finished fourth in total return during that period. I think that was without reinvestment of dividends. And we beat the median performance. A lot of negative total returns, of course, on that slide during that period, because it did end in May 2020, sort of at the depths of COVID, a couple of weeks or a few weeks after the negative price day for WTI that was so memorable to everybody. But in any case, we on a relative performance basis, we beat the median company or the average company by about 40% during that 8-year period. And again, finished fourth out of 24 in public market performance, running a similar model, I would say, to what we intend to run full cycle at Tenaz. And we We also had substantial growth in production. I think it roughly tripled during that 8-year period while paying a lot of dividends. So that's the record. And we do intend for Tenaz to provide production growth. We're a small company today, but we're on a pretty good growth path. I think I've got an exhibit on that later. At the same time that we do intend a return of capital the whole time. Again, currently we're doing it at Tenaz through a modest buyback program, but over the longer term, we would hope to have a dividend as well. And so I think that's the slide you're referring to, and speaks primarily to the relative performance, first out of 47, then fourth out of 24 over those 2 8-year periods. And then the fact we were able to grow while kicking out a stream of dividends. And that return of capital is pretty important to investors. I've always been a believer in it. The way I think of it, it kind of reduces risk to investors, sort of pulls down their basis over time. And it also enforces a great deal of discipline on the managements. You really had to crush a lot of cost out of the system to run that model consistently on a self-funded basis. And then that's what we did in the other companies with really quite a massive improvement in capital efficiency. And, the whole industry is more efficient today than it was back there from 04 to 20. But nonetheless, we do believe we can bring to bear improvements in capital efficiency as we move forward in this enterprise too. And probably we'll get a chance to touch on that later. So maybe we move to the next slide, please, slide 6. I want to speak just briefly about our board of directors because I'm quite proud of the board that we have at Tenaz. Marty Proctor is our chair. He has a great record in the industry. He ran a very successful company at 7 Gens that had massive growth and an ultimate liquidity event, selling to another very large company, ARC Resources, another very strong one in the industry. He is now on the ARC board. I had worked with him previously at Tenaz Energy, and he's a tremendous operating and capital markets, oil and gas professional. He also has a great deal of experience in the use of ESG for the benefit of the shareholders, which is the way we think of it at Tenaz. Our previous companies, all of us here, the management plus the directors represented had a great record in ESG, and we think can be done in a way that is compatible with shareholder value, and that's what we would intend to do here. Anna Alderson is our audit chair, a very important position on the board. She is an ex-audit partner at KPMG, and she's got a great deal of experience both in energy and in the capital markets. A great director and perfect for our company. John Chambers was the continuing director from Altura, and we are very lucky to have him. He's got a technical background, really spent the vast majority of his career in the capital markets, being one of the founders of First Energy, now owned by Stifel, one of the successful Canadian boutiques that started here in Calgary with a real emphasis on energy. Mark Rollins is the 4th independent director that we have. Mark is a British citizen who has quite a record in the industry. He was basically co-COO of British Gas during its growth heyday. Subsequently ran Ukronafta, the second largest Ukrainian E&P company, and a very strong record as well in the smaller company part of the sector in both private and public companies. He as well has a technical educational background, and kind of like John Chambers, really spent the bulk of his career working in the commercial side of the business. I'm the non-independent director who is on the board. So again, we're very lucky to have this board. Really, I think all the expertise sets that we need are represented, and this real strong ESG focus that the directors bring. So if we could move on to the next slide. This is a summary really of what we've done since the recapitalization. 2 graphs at the bottom, production on the lower left showing where we started with Altura. The recap occurred in Q4 of 21, so 800 to 1,000 barrels a day of production at that time. We are up to a guidance level approaching 2,500 BOED. There's just a small piece shown on here for the second Netherlands acquisition for XTO that we just recently announced. And that is because you can only count the production and cash flow after you close the deal, which did occur in the early part of July. So we were counting, I think, pretty conservatively on the guidance, what that can contribute for the rest of the year. I guess on a run rate basis, we're probably 3x roughly where we were with Altura. So pretty good production growth. FFO is up a lot, or cash flow up a lot since the recapitalization or since the Altura phase of the company, about 9x. That reflects the production growth and also improvement in prices, and therefore improvements in margin and bringing in higher margin assets as well in Netherlands. The next point we try to make on this slide is the third bullet that is listed there. But at the same time, we've had this growth in production, we've had this growth in cash flow. We actually have a lot more cash available to us than we had when we started out. I think right after the recap, paying off the Altura drawn part of the bank line, we had about 25 million Canadian in positive net working capital. That is up pro forma the XTO transaction. And what we're saying here is we take the Q1 financials that we release plus the cash brought in with the XTO deal. That implies about 65 million of negative net debt. So up twofold, 2.5 times in this working capital or negative net debt at the same time that we've had this big growth. And we have had a buyback active that has brought the share count down by about 3% since the recap. So we feel like here, to summarize, production's going the right way, cash flow's going the right way, cash is actually increasing, net working capital, negative net debt, whatever terminology you want to use on it, is up substantially. And at the same time, the share count is down by a little bit. So things we feel like on this slide, looking for a simple way of representing it, we feel like going in the right direction. If you turn to slide 8, please, we'll take a little more complicated view, and I'll try to keep this simple in terms of liquidity in the graph at the top. So what we're trying to represent here is 3 bars for each of these points in time. The first segment is working capital. The second is available bank line capacity. And then if you add that gray one and the blue one together, you end up with the net liquidity available. So Altura, at the end of 20, had a little bit of negative net working capital, some undrawn bank line, and just a little bit of liquidity available. We executed the recap, had some cash then, and we were beginning to establish a little bit more of a undrawn bank line, paid off the debt, a little bit more of a bank line that we subsequently expanded with ATB primary lender there. So we had this mid-20s available liquidity at the end of 21, post recap, about the same number end of 22, and now with the cash flow in Q1, the FCF in Q1 plus the expanded bank line, which is undrawn, we end up with roughly 70 or 75 million roughly of available liquidity. Kind of the same point I was trying to make on the previous slide. Liquidity available at the same time that the growing liquidity available at the same time that the company has been growing. Market cap represented, it's in the footnotes here, I think it's as of the end of the second quarter, around $3 a share, a little bit higher maybe today. So maybe 85 million roughly, 85 or 90 million of equity market cap as of today. At the time of this slide, about 82 mil. You take off the Q1 working capital and the additional 46.5 million brought in with the XTO transaction, and you end up with an EV of maybe 15 to 20 million Canadian. And seems like a pretty low number in comparison to our cash flow generation or our FFO. Up to the market ultimately to assign a multiple to that. But historically, the previous companies, we did achieve premium multiples over time. There's no telling. Here, certainly it's a very different oil and gas market than we had in the previous companies, but and hopefully though an improving one. but it's up to the market to determine. But it seems like to us there's some room for multiple expansion here, given the pretty low multiples we would have of EV here. And a final point on the slide at the bottom is that we do have this liquidity available that we could apply for future acquisitions. So that takes us really to the end of the corporate materials for Tenaz. And if we go on to, I'm sorry, I do have one more slide on that. Briefly, the 23 outlook. The points here are that we're going to continue to drill in Leduc Woodbend, really the bulk of that activity occurring in the second half of the year, 4 gross wells. We have upped the production guidance again to reflect kind of a conservative representation of the second half of the year for production that would come in there. We didn't change the CapEx guidance. Netherlands in particular was kind of running below the level that we had forecasted for the CapEx required. So even though there will be some CapEx associated with the XTO component, we feel like we can largely cover that within the guidance that we've already announced. And we're going to continue on that, what we think is a disciplined M&A evaluation and offer program to make further acquisitions. The guidance, again, ends up, though, the way I've described the construction of that previously, 2,300 to 2,500 BOED, up a little bit, E&D CapEx unchanged, and a well count of 4 gross in Canada, 3.35 net. On the left, we have the product mix. Again, the way this is constructed with just a partial year accounting for XTO, still 37%, on a run rate basis, or for each of the remaining quarters, it would be a little bit higher number than that in the mix, high margin production there. And about 40% coming out of Canadian oil, very small component of NGLs in there, and the remainder AECO gas, most of which is more or less hedged in fixed price contracts going forward for the rest of the year. So that's where we are in terms of guidance and planning. Now I'm ready to move into the assets. So we'll start with Canada. I just have one slide on that on slide 11. So what we represent here on the Alberta map is the location of Leduc Woodbend, a little bit south of Edmonton. It's a pretty large field discovered by our predecessor, Altura Energy, and a great deal of credit to Altura, to David Burghardt, the CEO of Altura, who is with our company, our former colleague at Vermilion, who started Altura and then is now our SVP for operations. It's a shallow field, only about 1,300 meters deep. It's a conventional trap. It's not a pervasive oil or gas accumulation. It's a conventional, low permeability reservoir, but not ultra tight. At that shallow depth in the area of a lot of drilling to deeper horizons for the Leduc and other carbonates, this sandstone had been overlooked. And again, tremendous credit to Altura for recognizing that it was there. And it's really quite an economic development that we're very fortunate to have in our company, in a pretty big pool that Altura, now us, with some expanded leasing, pretty much have to ourselves in terms of the available development area. You can come up with a range of OIPs. Some of them have been estimated as high as 400 or 500 million barrels of oil originally in place. Pretty significant majority of that we have within our own leasehold. We have really control of our entire leased area. We have typically 87.5% interest. 1/8 is held by a U.S. private that Altura had brought in as a partner to kind of help finance the project over the last couple of years. We've got really complete operating control, which is something certainly that is desirable for us here. It's booked to a pretty low recovery factor currently. McDaniel does a independent reserve assessment at the end of each year. At year end 22, we have 12.5 million BOE, including the gas widgets that we'll produce in that count. About, depending on how long you want to develop the wells, about 40 or 45 wells on the books. We think there is, a meaningful number of other potential locations that, in McDaniel's view, didn't qualify under NI 51-101 for this year's reserve report that we hope can come on the books in the future. There is a lot of infrastructure in the area for oil and gas production. On an overall basis, I think it leaves a lot of room for future development and production expansion. We do make some investments to expand the facility capacity in some of the specific nodes in the field, but it's generally quite well served by infrastructure. It's a flat area. There's not too many residents in the area, which makes the surface development proceed even more smoothly. We of course do use pads for these long horizontal wells, as you can see, and that further reduces the surface footprint. Good labor force south of Edmonton, of course, very skilled in oil field operations, good access to the highways. So a lot of things really going for this area. It's pretty inexpensive to develop. We've been going to longer and longer wells. This is kind of an example of the operating improvement that we seek to bring as Tenaz when we get into a new asset. And I'll point out again, Altura did a great job of finding the field. They did a great job with the initial development using somewhat shorter wells than we're using today. They started out at about a mile, and probably their typical well was in the range of 1.25 miles. We are now drilling close to 2.5 mile long wells. The concept in going longer, of course, in your horizontal laterals is that it's only one vertical well that you drill the horizontal well off of. There's only one surface setup. There's only one pumping unit that is required. So you go longer and longer and longer, and typically you improve your capital efficiency when you do this by having more and more productive area with a kind of a more or less fixed amount of vertical well and surface investment required. We've also gone to tighter frac spacing. So this is what I would call a tight oil reservoir, probably in the mid-single digits in terms of millidarcies of permeability. It, of course, varies throughout the column, varies over the field. It's not an ultra tight. It's not a shale. It's actually the really ideal form of reservoir that we like to work in. I call it semi-conventional development, where it's a conventional trap, but we use an unconventional method, a long horizontal with multi-stage fracs. Some of these longer wells are going to have 120 or 130 frac stages in them. They're small fracs. They're not the massive kind of horizontal fracs that you would use in a real tight formation in a shale, but they're effective at getting good wells. And now we can bring the wells in typically for $3.5 to $4 million, even on the very long wells, and get quite strong efficiencies and rates of return when we drill them. It depends on the oil price. Working at around 70 TI, we'd see roughly 65% IRRs, ATAX IRRs on these wells, and payouts a little bit over 1 year. So quite economic, and it's a kind of field that we can conduct a development program in at a reasonable level. This year, 4 wells. Over time, we'll probably step that up and have growth at the same time that we throw off free cash. This year, starting from a pretty low base, last year I think we had 1,200 day barrels out of the field, BOED. We should be up 20, 25, 30% in production, and we look forward to continuing production growth from the field for a few years. It is not a big enough field ultimately, although it's a good sized field to, in terms of its ultimate rate potential, to be the sole asset to support an intermediate sized E&P, but we think it's a valuable piece, and we're going to continue to develop it as it grows and contributes to our free cash profile. So that is the Canadian asset. We move on to slides 12 and 13. We'll talk a little bit about the Netherlands. We've got a few different slides that describe this. So a couple of more general points, I guess, to begin with. We are in the Dutch North Sea, the Dutch offshore. Pretty shallow water, starts at about 25 meters, probably gets as deep as 50 plus meters, in the range of 25 to 30 to 50 kilometers offshore. Generally pretty permeable formations, Rotliegend being the main producing horizon, a real mainstay of the big Dutch industry for decades, the Rotliegend sandstone. We currently have made 2 non-operated acquisitions in generally the same set of assets, primarily operated by Neptune Energy and to a lesser extent by Wintershall in some of the undeveloped blocks. In aggregate, we've got a little bit of a combination of dates on the reserve reports. In aggregate, something approaching 2 million BOE of recognized reserves between the 2 transactions, the original private at the end of December and XTO in July. We'll talk about it in a little bit more detail later, but we have a 21% aggregate interest in one of the 3 offshore gathering systems for the Netherlands, and we have the potential to invest in a CCS project that would occur in some of the depleted offshore gas fields. Not sure yet what the rates of return on that would be, and it's a decision we'll have to make over time about our participation, but it is an opportunity to invest in that. I'll maybe touch on that very briefly too in a subsequent slide. Yeah, I was just going to point out on that previous one, using that same methodology on how much production we count for XTO this year, it'd be 850 to 950 BOED. It's a little bit more than that on a run rate when you don't just take the calendar average for the year. Yeah, 4 to 6 million of capex we would see on the combination of the assets that we own. There are, if you go to the next slide, on slide 14, we do have some undeveloped assets here as well. What we would refer to here are really primarily fields that have been discovered, maybe under the pricing that existed previously, or maybe because in some cases producing capacity was all taken up on the gas platforms, not tied in to date. Prices are higher today, and since the fields have declined in production over the last 30 years or so, there would be typically facility capacity available. There is some opportunity to tie in some of these undeveloped gas discoveries in the Neptune area, and then in the Wintershall operated area, we have a 5% interest, a lower interest in the Wintershall area, in a couple of undeveloped oil discoveries, pretty significant pools potentially, called Vermeer and Rembrandt, a little bit in the northern part of the leasehold that we have. It's thought that these fields have the potential to produce up to 20,000 gross BOED. A 5% share of that would represent maybe 1,000 day barrels of productive capacity to Tenaz if FID'd and developed. That development would probably be a few years off still, but potentially some valuable fields and a little bit of a Brent mix, Brent oil added into our product mix, potentially if developed. So, there's always a stream of workovers here. There's potential for some development drilling and some tie-in of already discovered fields on the gas side on top of that oil potential. So if we move to the next slide, please, slide 15. This speaks a little bit more to the pipeline infrastructure. In the 2 transactions, we end up with about 21% equity ownership in NGT system. There's 3 offshore producing, offshore midstream gathering systems in Netherlands. This is the northernmost of the 3. I think it's pretty well positioned. It's got the potential to tie in one of the biggest recent discoveries in the Dutch offshore when developed over the next couple of years, called GEMS, on the German maritime border. And that's a way for the throughput in the system to bump up and then be maintained over time versus just the base profile that we acquire. It's a very high quality system, very well maintained. They've had close to 100% uptime over the past 30 years. It does have a potential application in the energy transition as well. It's licensed to carry green hydrogen, and it's a good source of ongoing free cash that we acquired in these first two deals. And then the last component here is that potential CCS project, slide 16. So the concept here is sequestering significant quantities of CO2 into depleted fields. There's, of course, a lot that has to happen throughout the industry to make this a reality. You need gathering systems onshore, you need purification, and then you need some investment into the injection capacity as well, wells and pumps and platforms to do it. But if it proceeds ultimately, the project could really sequester a great deal of CO2 at our share, potentially around 11%. If we are an investor in the project ultimately, it would have the potential to offset up to 50,000 BOED of upstream production in terms of carbon profile, so a significant one, and we think a good option for the company to have. So that is really the Netherlands asset that we own. So the first two pieces, I've covered our corporate overview, I've covered the assets as they exist today, and then in this third piece, it's quite an important one, but really I think I can use only maybe one slide to describe it. We'll talk about the objectives of the company going forward, our vision. And the slide I think I would like to use, we've got a whole section here, but on this topic, but I think I'd like to use just slide 19 to describe this. So the opportunity that Tenaz sees is that there's quite an opportunity, we believe, in the overseas industry, and I mean by that outside the US and Canada, to make acquisitions, employ an acquire and exploit strategy, and to get potentially, we think, quite good returns on it. And there's really two pieces to this. The first is that typically the transactions will go off at lower multiples in the international industry. And I think the reason for this is that there's just really fewer qualified bidders in the international industry than you find in North America. The North American industry is very well developed. There's still a lot of, although it's winnowed down some, there are still a lot of companies that are involved in the industry. Typically, they're pretty well financed. Operating capabilities are quite good. It's a very competitive industry, both kind of in terms of operations and very competitive in terms of M&A, a real dog-eat-dog industry that's quite efficient today. Now, historically, in our previous companies, we did make acquisitions in Canada and the US, and we were successful in those, making good returns and actually improving the operations, even though you start from a pretty strong operating competence base in the US and Canadian industries. But we found in our work that in the overseas industry, we could typically make better deals because there were fewer companies to compete with, fewer qualified companies in terms of financing, in terms of ESG credentials, in terms of operating capability to make the deals with bigger companies there where they could rely on us to steward the assets going forward, where the governments were accepting of us as a participant in the industry and ultimately as an operator in the industry, and where we had the ESG credentials to be accepted into the communities there. And because of these, I would say, requirements in the offshore, and not just offshore, but in the international industry, there just aren't that many companies that you compete with when trying to make an acquisition. When you go against fewer competitors, you end up with typically better multiples, better implied rates of return at the time that you make the deal. So that's the first advantage we see in the overseas versus the domestic. The second is that typically there's greater opportunity for improvement in the operations. Kind of goes back to some of the topics that I just mentioned in the first part, but while the industry has gotten better and better, I think, in terms of operating efficiency worldwide, it is still just not as competitive in these overseas assets as it is in the North American industry. And so oftentimes the assets have been underinvested. there's usually quite a well-qualified national workforce, technical workforce that is very well educated, strong ability to generate project ideas, but maybe not such an emphasis on getting these projects implemented. Oftentimes they didn't make the capital slate for the current big company owners because these assets just aren't areas of focus for them anymore, being typically more mature. This goes, I think you can see how this would be the case when these assets are, available for purchase. They just aren't, major areas of emphasis for the current owners. So kind of underinvested, probably not as great an emphasis on unit cost production, improvement in production curves over time as we would have in the North American industry. So typically we would bring in some North American content from the US and Canada in the technical ranks and in management to feather in at a minority percentage within the existing national workforce and get better results out of them over time. So you have a better rate of return at entry and you have a greater opportunity for improvement in the performance of the asset. You put those two things together, you end up with a better return on acquisitions, I think, than you can get in North America.
Now, Tony, sorry. When you say greater opportunity of operational improvements, I think you also refer to a lot of technical stuff that might be done in North America, but that's not so well known in these other fields elsewhere. Can you give us some color on that?
Yeah, there's a whole range of examples, I think, of things that maybe have a little bit more emphasis in North America than they would have in the international industry. Some of it would apply offshore, some of it would apply to a greater degree onshore, and we're experienced in both of them and willing to invest in both. Really, it's all return focused for us. It would range from the recognition of some of this semi-conventional potential that we've like we're employing at Leduc Woodbend and have previously in the predecessor companies of ours. And that would be the use of horizontal wells in clastic reservoirs, conventional reservoirs that are low perm but not ultra tight. We're really not so much after the shales with all the expense and the super high decline rates associated with those. But in these lower perm sandstones, typically we could use horizontal wells, some with small multi-stage fracs. In other cases, if we have a little bit more permeability or a better oil quality, we could use multilateral horizontal wells, as we did with a great deal of success at Baytex at Seal, one of the early adopters of that very good technology, unfracked multilateral horizontals. So this type of thing often exists in the international industry, much more commonly applied, of course, in North America, but oftentimes the same rocks exist overseas within the strat column, but never developed in these tighter but not ultra tight conventional reservoirs where you can use a couple of different types of horizontals potentially. There are things in water floods that you can do to better control the injection profile in your injection wells, and to some degree the withdrawal profile by a vertical interval in your producing wells that are low-cost ways of just working over wells without having to drill new ones and to get better rate performance, lower costs, and higher ultimate production. In gas fields, sometimes working with multiple potentially productive intervals, you can do commingling of new zones that sometimes is not applied in the existing industry. In certain cases, all of these different types of enhancement opportunities are present depending on the geology. Other cases, you might only have one or two of them present. Also improvements in artificial lift, things like that that are sometimes overlooked or not maybe tenaciously pursued enough. And these are the types of things often that we find in the international industry that aren't quite as available typically in the domestic industry.
Thank you for that.
Yeah. And I want to make one more point on the international strategy here on this map sheet. So the combination of the two shades of blue are the jurisdictions that the Tenaz team has worked in historically. So pretty good coverage even in Oceania and in Asia. It's only the darker blue jurisdictions that we would consider potentially areas of investment for Tenaz. So we actually have a pretty wide geographic funnel, and there's a conscious reason for this. We wanted to have Europe, MENA, Americas available to us to have a wide range of potential investment opportunities. We do feel the strength of the company is the ability to screen potential acquisitions and kind of separate them out at early stages where there's little potential and pursue with a more detailed evaluation and potentially an offer the ones that we think have a better opportunity for success in making a deal and for higher returns. So we kind of take a pretty broad geographic funnel and we make a wide range of geographies available to us within that to try to find the highest rate of return deals. We do have experience in those areas. That's important on the team. It ends up with the geographic tiering that I talked about earlier. Most emphasis in Europe, not all jurisdictions that we would consider investing in, but a large number of them. And secondly, in MENA, Middle East, North Africa, and then a pretty broad optionality, I would say, within the Americas, primarily Latin America, but we're not going to exclude Canada from that list. So this slide kind of captures both the opportunity in terms of returns that I talked about at the beginning, and then that wide geographic funnel that those geographies that we consider and how we prioritize them. So that would bring us to the probably the last slide to cover. I think I can just summarize real briefly on 23. We got a lot in this section on acquisitions. I'll leave it to you to look at in greater detail if you choose to on the website. But if you go to 23, I'll just finish with a summary of the company. One, we think there's a significant opportunity to use this acquire and exploit strategy in the overseas markets. We think we've got experience. The second point, we think we've got experience in doing that, and a lot of transaction history, both buying and selling, in the team. And thirdly, we're aligned with the shareholders. We're all owners in the company. Management invested in the original recap, and we're committed to doing our best to provide those returns for the owners in a combination of returning cash and having growth in the production and cash flow and free cash in the company. So that is the Tenaz summary.
Thank you. That was an awesome presentation. Now let me have some questions. I was wondering, how did you got around to close the XTO deal so fast? Because we got a news release saying it will close the third quarter, and we are used to a lot of delays in this industry. And just, I don't know, after 3 or 4 or 5 days, we just got the deal closed.
Yeah, a week or so there after the signing of the SPA. I mean, it was the first thing, it was a relatively simple deal to close for us. And we had set up a lot of it before we finally inked the SPA. So we were well set up on it with a relatively simple transaction. And the second point, we were incentivized to do it early in the quarter. The way our counterparty wanted to work the accounting, if we didn't get it done early in the first month, we were going to have to be delayed to at least 1 month later. So a strong incentive for both parties to clear off their accounting and get it out of the way very early in the third quarter. Those were the drivers.
Okay, thanks for that. Also, what can you tell us about the process for sourcing and screening deals, and what are the value parameters that you are using? And how do you generally see the M&A space within your targeted regions, and what competition, if any, are you facing?
Okay, so I'll start in reverse order there, and let me know if I forget any of those four components.
Okay.
So when it comes to competition, it is, I would say, as I mentioned earlier, a little more limited than we would find in the domestic industry. It's hard to characterize exactly how many competitors we would go against, sometimes zero. Certainly, oftentimes there are unsolicited offers that we've made on assets that we're already familiar with, and there wouldn't be a process, kind of like a competitive process going on. Even in some of the competitive processes, because there's not that many well-qualified management teams, meaning both financing and capabilities, you might have zero, one or two competitors, generally the number lower than you would find in the North American industry, where it's quite possible that you could have 4 or 5 or 6 bidders at the final date on some of those competitive processes in the super well-developed North American industry. So usually it's a pretty low number, preferably zero. That would be the best circumstance, but usually low. And having a low number of competitors is certainly a driver to higher rates of return. I was going to try to go in reverse order. I didn't write down the rest of the question.
Yes. What was the value parameters that you use?
Yeah, the value parameters. Yeah, we usually have 5 criteria that we try to apply, 3 of them quantitative and 2 of them qualitative. The first is a rate of return requirement, and usually on an unlevered basis, what we're seeking here would be double our cost of capital. Cost of capital is not particularly low in this industry anymore. So this usually would drive us to seek on an after-tax basis 20 or 25% IRRs unlevered. I know it's a higher rate of return, but when you have that targeted IRR, that IRR hurdle, it does give you quite a bit of room to make sure that if you actually make a deal and close a deal, you're going to be adding value for the shareholder. So it's a tough one. It's a strict one, but it's a good one to have, and it's one of the main tests that we would apply today. Secondly, we would typically seek accretion for the existing owners and all of the key measures on a 3 to 5 year basis, and this would be in comparison to the projected growth in the base assets of the company. So we've got a base forecast for growth out of the existing assets that we have. We would tack on the existing assets to create an alternate case with the new assets plus the old ones, and we would want with that change in production, cash flow, free cash flow, if possible, reserves per share, all of these things on a per share basis to add to what the shareholders in the company have today before we make the deal. So making sure that that alternate minus base is accretive for the owners. Third test is kind of what we call a cash in the genes test, and that's to make sure that what the assets will generate in terms of cash flow covers the capital required. If it's a growth asset, even the capital to continue to grow its production, and it's when we have a dividend, it's dividend load as well that would be associated with issuance of any new shares. So to make sure that the cash flow covers the capex plus the dividend load that we would have from the share issuance, and in all 3 of these tests, we would assume that whether or not it's all financed with equity in the company, the assumption would be that these calculations would be performed as though it was all equity financed as the most conservative way of evaluating a transaction. This makes sure that we wouldn't be getting the improvement for the existing shareholders just out of taking on more leverage in the company. So those are the 3 quantitative tests: rate of return, accretion, and cash in the genes. We would have 2 qualitative tests, the first of which would be, is it in the right geography? And the second of the qualitative tests would be, is there some way we feel that we could add value to the performance of the assets? Now, we started with a couple of non-op deals in the Netherlands, it's true. We are attempting to exert as much influence as we can with the operators there in terms of our technical approach. And it's early, certainly it's early in the process with respect to that, but we've got two very receptive operators that we believe are willing to listen to the suggestions that we might have. And we do view those ultimately as a stepping stone toward creating operatorship in the jurisdiction. And that's certainly when you can bring to bear your full range of technical and operating capabilities to improve performance. So we feel the initial deals would qualify on this fifth test of ultimately being able to add some value to the assets. So those are the tests that we would apply.
Okay. The other component of the question was how do you source these deals?
It's a whole different whole range of ways that we source, and it can range from dealer ideas that are brought to us to unsolicited ideas that we have from having worked a number of these basins previously and having some familiarity with either the assets that we're pursuing or similar assets in the basin where some of these ideas could be applied. So there's a whole range of sourcing: dealer relationships, operating relationships that we had with the directly with the sellers, potential sellers over the years, technical concepts that we have, research that we do on ownership and technical and operating characteristics of the properties, a complete range.
Okay, thank you. Also, on the deals, everyone and his mother wanted me to ask you about things that I know you cannot reply to, like giving timelines for the next deals, specific countries you are dealing with right now, and things like that. I guess that's a no-go as well.
Yeah, we stick with the geographies kind of in order of priority: Europe, MENA, Americas, optionality in Canada. Timelines, it's just as you said. I mean, it's interesting to everybody, but we just can't ever disclose. We would disclose at the time we have a definitive agreement. That's at the point at which they're, we signed. So there's a very 100% probability of proceeding toward closing. There'd be some risk in some cases, I suppose, that you still wouldn't close. But it would be certain enough at the time of executing a definitive agreement, a share purchase agreement, or a purchase and sale agreement, depending on whether it's enterprise or asset deal. And that's the only time we can disclose. So I know it always kind of comes down as a surprise to the market, but in the interest of conservative and broad disclosure, we just don't see another way but to only disclose at the time of that announcement of the definitive agreement.
Yeah, sure. What I think you can ask, what you can reply to is, if I ask you, so people get an idea, what are the smaller and the larger size deals that you have looked at in terms of BOE production?
Well, it's kind of like I don't know if you have it in Spain or not, but oftentimes in the U.S. or Canada, you'll see these advertisements by companies: no job too large or too small. That's kind of how we feel about it. We pursued the stuff that is 500 day barrels already. When since we did the recap I guess it's been about 21 months, we have looked at some very large acquisitions. In fact, even at the very beginning, we had one that we considered that was 125,000 BOED, multiple jurisdiction overseas. And we thought we had a pretty good shot actually at that one originally. Ended up, the company didn't sell. I think they ended up selling 2% of the portfolio in an asset deal. That kind of reflected the market that we had at that time, in the end of 21, beginning of 22. Coming out of COVID, you had this massive increase in prices because investment had been super low during COVID, and there was all this pent-up demand for the products. So you had a huge run-up, and then that got exponentially exacerbated by the war in Ukraine. So it was a tough time because there was so much cash flow coming out of the high prices. A hard time to make a deal, and whereas right at the time of the recap, we thought we had a pretty good shot on that big one. It just sort of went away when the seller lost its incentive to sell. So we looked at a number of bigger deals over the past couple of years, going into the recap and since, all the way up to that one. That was the biggest one we looked at, but I know it's a pretty large range there. But looking at the history, 500-day barrels to 125,000.
Yeah, that's quite a spread, really. Okay. Now onto your Canada asset. I have always told people that even the old Tenaz prior to these Netherlands deals was already undervalued, just on the single asset alone, in my opinion. Now at the AGM, you mentioned that the new Leduc-Woodbend wells you are drilling, you are getting better results than what they were getting under the old Altura management. Has the estimated ultimate recovery increased, and if so, by how much, please?
Yeah, I mean, I think it has. The way we pump the wells, every field progresses over time along a learning curve, and Altura got us a very good start. But originally, Altura would sometimes capitalize for a little bit bigger producing capacity, bigger pumping units, typically rod pumping units is what they used. We have kind of gone to more standard, a little bit smaller size. It sort of flat tops the performance. We have a longer buildup period and production rates during cleanup because we're not pulling as much rate out, as much drawdown at the very beginning. So we have a flatter profile and a larger EUR. I didn't actually bring those statistics with me to indicate on a per well basis. Now we are drilling longer wells. That's part of the efficiency. It's a big part of the efficiency improvement that we get. When you go longer, typically you do get better EURs out of the wells. Now we aren't managing them for sort of peak rate at the very beginning. We're willing to capitalize lower and shave off the peaks a little bit and have a flatter profile. But you don't usually get a exactly linear improvement increase in EUR per additional meter drilled. The end of the well isn't quite as productive as the beginning of the wells for reasons of drawdown, primarily, I think. But we do get an improvement in EUR on a per well basis. I just don't have the statistic available to show exactly how much on a per well basis. We can go back to the reserve report, and that's really the kind of the official arbiter and the independent arbiter of the performance of the wells. But certainly it is improving on a per well basis, and it's improving on an economic basis as we've gone to these longer wells.
Okay, thanks for that. If I'm not mistaken, it has been said that Leduc-Woodbend could reach 4,000 to 5,000 BOP. How long would you expect for you to reach that production size, and how long would it plateau at that size?
I think in our LRP, as we built it up, we gave it about a 5 or 6 year buildup to get there. We're not, again, sort of like with the pumping equipment, we're not really trying to shoot the lights out on rate development, looking kind of more for a rateable increase over time. So we were taking probably another 5 or 6 years to ramp up. The plateau, I think, was another roughly 3 years, something like that, before it would go into decline. It's something like that, approach an 8 or 10 year period before you would go into the kind of the long-term decline. Nothing wrong with long-term decline either if you're not putting really very much capital back into the field, because that's kind of a period of maximum FCF development. The amount of cash flow and the amount of FCF is going to depend on the oil price too. But we do think during the ramp-up period, as we build up bigger and bigger rates, it could be quite an FCF producer as we're continuing the remainder of that ramp-up.
Okay, awesome. So now back to the Netherlands. You mentioned that the development of the two discoveries Rembrandt and Vermeer could take a few years. Can you be more specific on sort of a timeline?
I think it would be probably at least 4 years before you could get those fields on, probably more like a 4 or 5 year period to getting them on production.
Okay. Do you still see further opportunity to increase your working interest in the Netherlands assets?
This would involve further acquisitions, and we'd be open to it without any question. We kind of like the question that you had earlier on the timing. We tend not to speak to the potential for specific transactions, but we'd be open to it in that asset set or in surrounding ones. For sure, we'd be open to it.
Okay, fine. Also, to finish, I would ask you, how long do you plan to stay with Tenaz? And what would be your long-term, let's say 5 years or so, vision of where it will be in terms of size, shape, and returns and of capital and so on for shareholders?
Well, where we'd like to get in 5 years would be 100,000 BOED company. That's sort of the vision, at least expressed in rate terms. We do sometimes use that production rate descriptor because I think it'd be clear to people. We get up in this 50,000 to 100,000 BOED range. We'd have, we think, probably operating scale, and we'd have capital market scale, which we know has become more and more important. We're actually after value in each case. It's not so much about the rate, but people do use that rate as a proxy for kind of scale, mid-cap size. And we would hope to be there, and we don't want to stop there later on. You know, my own involvement, I got a great management team that I work with. I'm super lucky to be able to work with this group of people that, you know, we've been together for such a long period and very like-minded. As a team that is very well set up to take over the company when I would ultimately retire. I don't have a specific time frame on that. I mean, I would hope it's at least 5 years, but you know, I wouldn't want to project beyond that. If it's then, or if it's for any reason before that time, I think you could feel very comfortable that the company's in very strong hands with the management team that I mentioned earlier.
Okay, thank you. Okay, before I give you the chance for the last words, I would like to acknowledge that you did 2 previous videos on YouTube, which was Trevor Rose podcast. It was a great conversation, and also with Shubham Gang of White Tundra. You did a long interview. I would really recommend the people who are interested in your company to watch those videos as well. I'll put the link to those videos in my YouTube channel below this video, so people can get a more holistic view of your company and of Anthony Marino. And well, now maybe you can give us your last words, and maybe give us your contact if someone wants to contact investor relations. What's the email, or how can they go about it?
Yeah, our investor email is investors@tenazenergy.com. And website would have this contact info as well. In addition to the presentation I covered today, I skipped through a few slides there, so I encourage you to take a look at it. You've been a great interviewer. I appreciate it very much. We've been, I think, very lucky with our small cap status to have a number of these good internet-based, kind of social media-based interviews. You mentioned Trevor Rose's. Shubham's earlier was a really good one, and like you, they're both very good interviewers. We've got a couple of, we've got at least one private one, Keith Schaefer, that I don't think it's broadly available beyond his subscriber set, but for sure we've been very lucky to have a few different opportunities to tell the Tenaz story. And in closing, I just want to thank you and everybody for the time that you have spent to listen. And, you know, it's our intent to deliver for the shareholders. for you, for those of us, all of us in the company, we're shareholders, and for all the other shareholders who have taken the risk with us. We'll do our best, and we'll apply this Tenaz, determined approach to trying to create that value. So thanks very much.
Thank you, Tony. It was a great interview and presentation. See you. Thank you.
Okay, my pleasure.
Bye.
Goodbye.
Bye.